Could you turn your annual income into twice what it is now by choosing the right stocks? Well, in investing, high-yield dividend stocks are not just a dream for those in the know. They're a strategic reality that can significantly enhance your financial portfolio. By focusing on powerhouse companies like United Rentals, BlackRock, and Pfizer, which offers not only robust dividends, but also the potential for capital appreciation, you're setting the stage for a substantial boost in your earnings. So, how can these dividends contribute to doubling your income? And what strategies should you adopt to optimize your investment returns? Well, keep watching to discover the keys to unlocking this dividend-driven growth. 1. Aries Capital. Aries Capital is the largest publicly traded business development company, BDC, which empowers mid-size businesses, particularly at the higher end of the market. Why should this matter to you? Because BDCs like Aries are legally required to distribute at least 90% of their earnings back to shareholders like us in the form of dividends. Aries Capital excels in this area with a robust 9.6% dividend yield. That means nearly 1/10 of your investment could be paid back yearly through dividends. Stability is key in investments, and Aries Capital has been a pillar of reliability, maintaining or increasing its dividends for 14 straight years. This kind of consistency could potentially lead to a return of over 80% by the end of 2030, just from dividends, regardless of stock price movements. Aside from a couple of exceptions, one during the Great Recession and the other in the pandemic-driven market slump, Aries Capital's stock price has shown remarkable consistency. Since it first hit the market in 2004 at $15.30 per share, it's mostly fluctuated between $12.75 per share and its peak of $21.92. Even with these rare dips, ARCC has bounced back impressively. For instance, after hitting its lowest point in March 2009, the stock surged by 378% by April 2010. Similarly, from its 5-year low in April 2020, it climbed by 85% by the year's end. Alongside its resilient stock performance, Aries Capital has maintained a strong record of dividend payments. Over a decade, from September 2013 to December 2023, quarterly distributions have varied from 38 cents to 51 cents per share, culminating in a total annual dividend of $1.92 per share in 2023. However, the benefits of investing in Aries don't stop at dividends. Historically, their share price appreciation has also been impressive, consistently outperforming the S&P 500. In an environment where many banks overlook mid-market companies, Aries seeks to fill this gap, seizing a lucrative opportunity to provide needed capital. With a proven track record, a solid financial footing, and attractive dividends, Aries Capital stands out as a potentially lucrative investment. 2. Prologis Inc. Over the past decade, Prologis has not just performed, it has soared, delivering a staggering 16.8% average annual total return. And guess what? It's almost the same story in the last 6 years at 16.7%. That's consistency at its best. But here's what really spices things up. Prologis isn't just about strong performance, it's about rewarding its investors. The company has been boosting its dividends impressively. Imagine seeing your dividends grow by 12% annually over the past 5 years, backed by a solid growth in core funds from operations, FFO. That's twice as fast as the average dividend growth rate of other companies in the S&P 500. So, what's driving this explosive growth? A couple of things, actually. Prologis is capitalizing on rent growth and expanding through smart development projects. They're not just growing, they're growing smartly, expecting to increase their core FFO per share by 9% to 11% annually all the way through at least 2026. And there's even more good news. Through strategically beneficial acquisitions, Prologis has been enhancing its FFO per share by about 1.5% annually. With an exceptional balance sheet, they have the financial leeway to continue making these savvy investments. All these factors lead to a sunny forecast for Prologis' dividends, which are expected to grow in tandem with its FFO. With a current dividend yield of 2.7%, the company might just increase its payouts at a double-digit rate annually. What does this mean for you? If Prologis keeps on this trajectory, especially with accretive acquisitions, you could look at total annual returns ranging from 12% to an impressive 15% or more. 3. Enterprise Products Partners. Enterprise Products doesn't just operate in this space. They dominate with a vast network that includes over 50,000 miles of pipeline, 40 natural gas processing plants, and 26 fractionators. Now, for the investors among us, here's the juicy part. Enterprise Products Partners is more than just a big name. They're a consistent performer when it comes to rewarding their investors. The company boasts a compelling distribution yield of nearly 7.2%. But it doesn't stop there. They've been increasing their distribution for an impressive 25 consecutive years. That's a quarter of a century of growth returns. Looking ahead, the future seems bright for Enterprise Products. With the demand for natural gas and natural gas liquids expected to rise, the need for robust midstream services will only increase. Enterprise is well positioned to capitalize on this trend, especially as the U.S. continues to lead as the largest exporter of liquefied natural gas. What does all this mean for potential investors? With solid distribution practices and a strategic position in a growing industry, Enterprise Products Partners is poised to potentially deliver a total return of 100% or more in the next few years. And let's not overlook the stock itself, which also holds promising prospects for strong performance. 4. United Rentals. Now, let's talk about a stock that could be the old faithful of any investment portfolio. United Rentals. Despite being relatively unknown to many investors, this stock has rocketed up an incredible 600% in the last decade. And here's the kicker, it still trades at just 14 times its trailing earnings. That's an opportunity knocking. United Rentals isn't just another company, it's a powerhouse in the equipment rental sector in the US, a market they currently lead. Consider a 30.7% free cash flow margin in the third quarter of 2023 alone. That's not just good, it's outstanding, showing how profitable this venture is. But wait, there's more good news for shareholders. United Rentals recently started paying dividends. In fact, this past February, they issued a $1.63 quarterly dividend per share. Annually, that adds up to $6.52, yielding about 0.98%. This was a step up from their previous dividend, highlighting a positive trend in shareholder returns. The strategy behind United Rentals' success is brilliantly straightforward. They expand their market dominance not just organically, but by acquiring other profitable rental businesses, often at low valuation, making quick returns on investment. On top of that, they've been buying back their shares, reducing their share count by 20% over the last 6 years. This trend of share repurchases could well continue into the future. 2023 marked the first year United Rentals paid out dividends, and while it's too soon to judge the long-term sustainability of their dividend based on this short history, the signs are promising. The company's low payout ratio of 18.44% suggests there's plenty of room to grow these dividends. and growth is indeed on the agenda. With a boost from increased infrastructure spending, United Rentals aims for a staggering $20 billion in annual revenue by 2028, up from $13.9 billion over the last 12 months. With earnings growing rapidly and a strategic approach to expanding its businesses and rewarding shareholders, United Rentals could very well evolve into a top-tier dividend stock. 5. Pfizer. It's one of the world's largest pharmaceutical companies, renowned for its extensive portfolio that includes everything from autoimmune disease drugs to cancer therapies and, notably, vaccines. Here's something that catches the eye. Pfizer's dividend yield is nearly 6.1%. That's not just good, it's ultra-high yield territory, defined as a yield at least 4 times greater than that of the S&P 500. This places Pfizer in a sweet spot along other dividend giants like Aries Capital and Enterprise Products Partners. With such a robust dividend, Pfizer might not need massive share price increases to double investors' money by 2030. Now, there are some concerns out there about Pfizer, especially regarding the potential decline in sales from its COVID-19 products and the challenges posed by upcoming patent expirations on several leading drugs. But let's look at the bigger picture. Pfizer isn't just sitting back. The company has projected a stabilization of its COVID-19 revenue and is actively gearing up for the future. With plans to introduce new products and expand the uses of existing ones, Pfizer anticipates generating an additional $20 billion in annual revenue by 2030. But that's not all. Another $25 billion is expected to come from strategic business development initiatives. What does all this mean? Pfizer is setting the stage for substantial growth, countering any potential dips from its patent cliff. When you combine this projected revenue growth with Pfizer's hefty dividends, you get a formula that could very well see the company delivering a total return of 100% over the next 6.5 years. 6. BlackRock. And finally, we're focusing on BlackRock, the largest asset management firm globally and a standout performer in the financial sector. Known for its robust dividend payouts and impressive returns, BlackRock represents a compelling opportunity for those looking to enhance their portfolios. Currently, BlackRock offers an attractive dividend of $20.10 per share over the past year, with a yield of about 2.69% at the latest stock price of $747.30. Regarding performance, BlackRock has an annualized return of 9.8% over the past decade. While this slightly trails the S&P 500's 10.1% return, when you factor in reinvested dividends, BlackRock's return climbs to 12.7%, edging out the S&P 500's 12.1%. As an asset manager, BlackRock's performance is closely tied to market cycles. Its funds and ETFs, which dominate the market, fluctuate with the overall market movements. Despite these challenges, BlackRock's leadership in ETFs and diverse asset management capabilities has consistently outperformed its peers. The outlook for ETFs in particular is highly promising. A study by Oliver Wyman forecasts ETF assets to grow from 17% of total fund assets at the end of 2022 to 24% by 2027. With its unrivaled position in the ETF market, BlackRock is perfectly poised to capitalize on this growth trend. Financially, BlackRock is also attractively valued with a price-to-earnings ratio of 20 as of mid-2022, which is quite reasonable for a company with such consistent earnings power. Historically, BlackRock has grown in earnings by an average of 8.3% annually over the last decade. Looking forward, BlackRock's potential for significant returns is even greater if we move into a prolonged bull market. For example, with a 15% return over the next decade, a $5,000 investment could double in just about 5 years. Even with a more conservative annual return of 9.8%, the same investment could still double in under 8 years. thanks to the dividend payouts. BlackRock is a dual threat investment, offering solid dividends and the potential for strong returns, particularly in a bullish environment. For those looking at long-term growth and steady income, BlackRock could very well be a golden ticket. And there you have it. By strategically investing in high-yield dividend stocks like the one we've discussed, you're not just investing in companies, you're investing in a future where your income could potentially double. So, what's your next move? Are you ready to adjust your investment strategy to tap into the power of high-yield dividends? Drop a comment below to share which stock caught your eye and why. Don't forget to leave a like, subscribe, and turn on the notification bell.